Welcome back to the exchange. It's been a disappointing start to 2025 for Apple. The shares are down nearly 8% and on pace to post their first 3-week decline since last April. My next guest sees a buying opportunity, $9 lower from here, around $2.20 a share. Let's bring in Bernstein senior research analyst Toni Sacconaghi. Apple is one of his top picks for the year, but he may not even be sticking it out. Toni, we're so glad to have you, and congratulations on your retirement, if that's what it is. I don't mean to age you, but anyway, when's your last day?
Good afternoon, Kelly. So I'll be staying on at Bernstein for the next few months, but I had my last investor call this morning. So as far as coverage of companies, I'm wrapping that up pretty soon, and I'm transitioning things to a successor. So thanks for having me on.
Who else is going to call IBM? You know, ride it all the way to the upside. No one's jump off. I think even just to the past year or so, some of the inflection points, like Apple, that you've picked up on, Toni. So that's why I'm glad to have you kind of weigh in on it today. Are you even going to pay attention to these stocks when you're done?
I've been doing this for 26 years, so I think it'll be very hard to go cold turkey in terms of not following these names to some degree. I've been following longer than my children's before my children were born. So I think you always follow your children. And in the professional world, these all are my children, so I'll always have some interest in them.
I love it. I love it. All right, so let me get to brass tacks for the investors who are kind of get to the last dribs and drabs from you. Apple, then, still you think is a top pick for this year. We mentioned there's a few other names in the Mag 7 that you think are not overvalued. So where do you think that things have the biggest upside for people who are getting in now?
Sure. So, Kelly, yes, Apple's had a tremendous run. In the near term, its valuation is close to its peak multiple. We don't think that the current iPhone 16 cycle is all that strong, and I think it's more likely that near-term numbers might go down rather than go up. So and also seasonally, the stock generally doesn't do very well in the September to March, April timeframe. So we've been encouraging investors to wait for a better entry point, ideally between 200 and 220. Our price target is 260. And so we would just encourage investors to be patient. Now, that said, we think if you're able to get at a lower price, or as we get into the March, April timeframe, and people start to look ahead to the iPhone 15 cycle, we think that will be very strong. We think iPhones next year can grow double digits. And ultimately, we think it's not implausible, that Apple could do $9 a share next year in earnings. That's fiscal 26. So at a 32 times multiple, which is Apple's, sort of high end of its range, that could be a $290 stock. So it's a great core holding. I think you want to be opportunistic about when you jump in. The stock has been pulling back. I'd still be patient. I'd wait to try and get it under 220, or I'd wait until we're a little later in the year to pick some up.
And do you think there's been a secular shift to higher valuations for these names than when you first started covering them?
Yeah, absolutely. I mean, I think if you look at the technology sector overall, Kelly, really what has evolved is you have more software-oriented business models across the board, even within my companies. IBM was much more of a hardware company 15 or 20 years ago. Today, 60% of IBM's earnings are coming from software. And you see that across the entire tech sector, where you've not only had more software entities, but companies are moving their businesses to be more software oriented. And so software is a higher margin business. It tends to have more recurring revenue. Obviously, we've had a movement to software as a service, and accordingly have much more predictability. And you have better free cash flow, where you're often paid before you recognize the revenues. And so for all of those reasons, better margin profile, better stability, and more visibility, we believe that tech should have a higher multiple. So historically, you paid a 20-25% premium for tech as a whole. We're closer to about 40% premium today. But historically, tech has grown revenues and earnings about 5% higher per year than the broader market. And so if you want faster growth, you have to pay up for it. That premium is higher today for the reasons that I just mentioned.
Well, I was going to tease you about Tesla, but we're out of time. So all I'll say is steadfast. You remain steadfast, and we all are excited to see how that narrative turns out. Toni, thanks for joining us. Congratulations again. It's been great to see you and to follow your career.
Likewise, congratulations on yours, Kelly, and all best wishes.
Toni Sacconaghi of Bernstein. Appreciate it.